What the heck is happening to Spirit Airlines, the aptly tickered SAVE, S-A-V-E? Back when the airline stocks were rocketing higher, Spirit, an ultra-low-cost carrier with a long track record of profitable growth, was among the hottest of the hot. But lately, the stock's been crushed, more than cut in half year-to-date, including today's more than 8% pace. And what's going wrong here? We know that Spirit has been slammed by a series of downgrades, but then this morning, the company reported a quarter that, at first glance, seemed to be pretty good. Company beating Wall Street's estimates by 3 cents off of a $1.32 basis, delivering higher than expected revenues, rose 10.6% year over year. How do we explain the stock's brutal decline? Well, in part, it's because the company warned about a volatile pricing environment on the same day when competitor JetBlue raised its full-year capacity growth forecast. In other words, it seems like there's too much competition in the airline space. That puts real pressure on pricing. Plus, when you dig deeper into Spirit's quarter, there were indeed some suboptimal numbers, including a 13% decline in revenue per passenger flight segment and a 17.5% decline in revenue per available seat mile. Those are hugely important metrics. However, when you consider that the stock is trading at less than 8 times next year's earnings, you got to wonder, has it been punished enough, especially since the analysts have already cut numbers pretty significantly over the last 3 months? Let's take a closer look with Ben Baldanza, the president and CEO of Spirit Airlines, to hear more about the quarter and his company's prospects. Mr. Baldanza, welcome back to Mad Money.
Thank you, Jim. It's great to be back with you.
All right, Ben, you and I have been around. We had this halcyon period where airlines made a lot of money, and it was kind of considered to be, let's say, sui generis, as I learned in law school. Never happened before. Is it over?
Well, you know, I think there was a sense a little while ago, Jim, that consolidation was good for the industry because it limited capacity increases and put capacity more in line with the industry's cost of capital, which kept prices stable. Since we've seen a big drop in fuel from the late last year, it seems that consolidation didn't have much to do with the stability of the industry. It was really high fuel prices that kept people disciplined. And now, with low fuel prices, the industry's just growing. And in order to fill all those seats that the industry has added, prices have come down.
Now, if that's the case, Ben, then we've got to go back to some things you said in the conference call, which were quite sobering. You've never dodged anybody's. I got to admit, it's great that you're here because you're not a dodger. But you did say, hey, listen, if this continues, next year's going to be lower earnings than this year. Ben, as CEO, you never want to hear that.
Well, you know, we don't want that to happen either, and we can't be sure if that will happen.
Okay.
But the current revenue environment in the industry, Jim, is a very dilutive one. There's a lot of seats chasing fewer passengers, and that's put a lot of pressure on fares. And if something doesn't change with that, what we're saying is the math could work out where that's true. But our crystal ball on the revenue environment for next year is just very cloudy right now. So while that could happen, we don't know for sure if that's going to happen.
But, Ben, one thing I don't want to see is that this industry goes from gain to loss. We're still talking about profitability no matter what in 2016, you think, right?
Well, I think it's important to remember, Jim, that Spirit has been profitable since 2007. We were profitable in 07, 08, 09 when the industry lost billions of dollars. We will be profitable in any fuel environment, in any recessionary environment, we believe. And the reality is, as Spirit has outperformed most of the industry in earnings, it's just that right now, because everybody can earn with really low fuel prices, our outperformance isn't as great. But we're still guiding to 21.5% to 23% margins this year. Let me ask you, Jim, if you had a show that was only based on companies that grew 30% this year and had 20% or greater margins, how long would that show be, Jim?
Well, that would be there's some show that would be about as long as some of the careers in the NFL when you're 0-6. Not long. Well, let me ask you this.
But that's where Spirit is right now.
Right. Now, let me ask you this. You use a term, you say you would, it's best interest of shareholders to use a scalpel versus a chainsaw. So you are taking some actions, but you're not wholesale closing routes or getting people to turning back planes that are supposed to be coming your way. None of that.
Well, we're a numbers-driven company, Jim, and so we allocate our capital based on the numbers they're producing. And the reality is our planes are really full, and we're making good returns with the flying we're doing today, so it doesn't make sense to make wholesale changes. Now, that said, the environment is punitive. It's very dilutive in the revenue environment right now, so it's certainly affecting where we fly and how much we fly. But we're a growth company, and we're going to continue that growth because we're able to grow and earn mid-teens margins at least through even a very punitive kind of revenue environment.
Well, let's put another spin on it. As prices have come down for everybody else, are more people traveling at least? I mean, or is there also a slowdown in the number of people who are traveling?
Well, a lot of people are traveling. If you divide the industry into sort of the lowest fares and the highest fares, our business only caters to the lowest fare customers. So we don't really know. We can't look at our numbers and see what's happening in the business travel in the U.S. or in that level of travel because we don't carry any of that business. Within our business, which means discretionary customers who just want a really cheap fare, business is great, and there's a lot of low fares out there for customers, and demand is very strong, which is why our planes are very full. It's just at a lower rate than it was a year ago, and that's what's put pressure on the unit revenues and the margins.
Is there some hidden, well, no, I don't want to use that term. Is there a way that discipline can come back in the environment? I know you guys aren't allowed to talk to each other. I know that there's scrutiny on the airlines constantly, but can discipline just kind of reappear?
Well, it all depends. I mean, the capacity drives pricing in the industry. Right. When there's empty seats, there's a demand to fill those seats, and that usually comes through price. Spirit's growth has been not predicated on lower fuel prices. Our growth is based from years ago, based on our ability to attract a segment of the market that has not been served by the industry. So we believe that our growth is going to be accretive in any energy environment. Some of the flying that's flying out there by the bigger guys probably won't. That's probably not as true with that growth. So the reality is I think I'm not saying anybody's being irrational. Everybody's being rational for their companies. What that means is lower prices for the world right now. Right. That's good for consumers. And at Spirit, we're a 5.5-cent ex-fuel cost per mile airline that's trending down. The rest of the industry is at 8 cents, trending up. So in an environment of low prices, it's good to be Spirit.
All right, Ben, thank you so much for coming on, talking straight, as you always do. Ben Baldon is the president and CEO of Spirit Airlines. Good to see you, sir.
Thank you very much, Jim.
Tough group. Man doesn't dodge. Comes right on TV. I like that. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.